Today, I'm going to focus on our ongoing efforts to promote maximum employment and stable prices. And I'm pleased to say that by these measures, the economy looks very good. The unemployment rate stands at 3.9%, near a 20-year low. Inflation is currently running near the FOMC's 2% objective. And while these two top-line statistics don't always capture an accurate picture of the overall state of the economy, a wide range of data on jobs and prices does support a positive view. In addition, many forecasters are predicting that these favorable conditions are likely to continue. For example, the medians of the most recent projections from FOMC participants and from the Survey of Professional Forecasters, as well as the most recent CBO forecast, all have the unemployment rate remaining below 4% through the end of 2020, with inflation staying near 2% over the same period. From the standpoint of the dual mandate, this is a remarkably positive outlook. Indeed, I was asked at the press conference last week whether these forecasts are too good to be true, which I have to admit was a reasonable question. Since 1950, the U.S. economy has experienced periods of low and stable inflation and periods of very low unemployment, but never both for such an extended period of time as is seen in these forecasts. Standard economic thinking has long offered an explanation for this. If unemployment were to remain this low for this long, employers would be pushing up wages as they compete for scarce workers, and rising labor costs would feed into more rapid price inflation paid by consumers. Of course, this dynamic, as you well know, between unemployment and inflation is known as a Phillips curve relationship. And at times, it can pose a fundamental tension between the two sides of the Fed's dual mandate. Many of us have been looking back recently in the last weeks and months on the decade that's passed since the depths of the financial crisis. And in light of that experience, I'm glad to be, and lucky to be able to stand here and say that the economy is strong, unemployment is near 50-year lows, and inflation is roughly at our 2% objective. And that the baseline outlook of many forecasters, inside and outside the Fed, is for more of the same. This historically rare pairing of steady low inflation and very low unemployment is a testament to the fact that we remain in extraordinary times. Our ongoing policy of gradual interest rate normalization reflects our efforts to balance the inevitable risks that come with extraordinary times, so as to extend the current expansion while maintaining maximum employment and low and stable inflation.